Thanks for joining us today on Market Call. I'm Morella Fernandez. We have a new guest on the show, Ernest Wong, head of research at Baskin Wealth Management. He'll take your questions on North American large caps. Here's how to reach us today. You can call us toll free at 1-855-326-6266. You can also send an email question in, marketcall@bnnbloomberg.ca. Ernest, good to see you.
Happy to be here.
Let's talk about Michael Burry in the U.S., famed American investor of The Big Short, of course, who has now sort of bet against two major tech players, Palantir and NVIDIA. Any reason you could see why he would do that? Obviously, we don't know why, but anything you could see that would lead him that way?
So obviously, Michael Burry is a great investor, has made a great call in the financial crisis. But I would distinguish between his negative bets from Palantir and NVIDIA. I think Palantir is a situation where you have a more speculative business model that has a very strong retail following. And so the bet here is a little different from NVIDIA, which is basically the picks and shovels of the AI revolution that is happening today.
Are you surprised then that he's bet against both?
I think I'm not surprised. I think that investors, especially those that manage hedge funds, have various motivations. You have no idea exactly what's inside his portfolio. But for NVIDIA, I think that this is, you can have your opinions about AI lists, but the reality is that AI is, the demand that NVIDIA is seeing is backed up by fundamentals. Companies are investing in AI, they're investing in data centers because they're seeing such strong demand for AI to use within their businesses. And I don't think, we don't own NVIDIA, we don't really have an opinion on the valuation, but there's no doubt that they've done a terrific job of positioning themselves to take full advantage of what's happening today.
Do you think investors are still really optimistic about the big tech companies, or do you see more sort of deliberateness in their choices these days?
So I think last year, certainly we saw the market was certainly healthily rational about the amount of money that companies were spending, especially the big techs, on AI. I think this year we're seeing a little bit more enthusiasm from the investment community, where a company might issue a press release and that is on something tangentially related to AI.
And people are piling in.
Exactly, and the stock would jump 30%.
Yeah.
So I think we're seeing a little bit more enthusiasm for the AI trade this year. But again, this is supported by real demand that is on the ground.
Okay, so we'll talk a little bit more about this later, but do you still suggest investors remind themselves to balance out? Because the incentive to go for tech and that high rate of growth is so high that sometimes it bears to remind people that they should balance out. If they should they?
No, and that's what we're seeing with the markets today, where you have these mega cap companies like Google and NVIDIA and Microsoft and Meta. And these are trillion-dollar companies that are still growing revenues 10, 20, 30%. And the valuations of these companies reflect that. Whereas you have the rest of the economy, the companies, entire sectors of the economy are really struggling with high interest rates, with weak consumer demand, such as home builders, the auto sectors, industrials. All of these companies are not growing at all. And so I think the hope is that for this segment of the market, as we go into next year where low interest rates are starting to come down and maybe uncertainties such as tariffs and maybe the SNAP benefits start to fade away, that this group will start to catch up with the rest of
everybody else. Okay. We'll take a quick break. We'll line up the first phone calls for Ernest Wong of Baskin Wealth Management. He's taking your questions today on North American large caps. Here's how to get hold of us. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. Ernest Wong with us today to answer your questions. We will start with an email from Cody, who says, Please, the analyst, review for CJT, which is Cargojet. Cargojet flies across Canada, is my understanding. So they're not really affected by tariffs, or are they?
So Cargojet is a provider of time-sensitive freight. So if you want to fly something from, let's say, Toronto to Saskatoon overnight, Cargojet is essentially the only game in town. A lot of the carriers, such as their customers, such as Amazon, such as UPS, such as DHL, they have really built their businesses around Cargojet's position in the Hamilton Airport.
Okay.
They do a good job. They've done a good job of performance, of delivering their packages on time. The stock's down a little bit over the last, say, three years or so, because after COVID, when everybody was stuck at home and buying things online, as society reopened,
that business wasn't as necessary.
Exactly. And so that's kind of what Cargojet is working through today. The valuations, we don't own it. It's a bit too small for our portfolios, but it's a very well-run company that could do very well from here.
Okay. Let's get to the phone lines then. Stanley is on the line. He's in Belleville, Ontario, with a question. Hi, Stanley.
Hi. Thank you for taking my call. My question's on Visa and I guess Mastercard too, but I'm invested in Visa. I've been invested in Visa and Mastercard back and forth over many, many years since their IPOs, but I've noticed the last year their chart is flat, and it's never been like that before. These two stocks, Visa, it just goes up if you look at its long-term chart. But the last year, it's completely flat. Although it's up today, the markets are down, but it's up today, ironically. But can you tell me what is going on, and would you still buy at these prices, anticipating more future growth? Thank you.
Thank you for the question, Stanley. So, yes, they've been going sideways. Visa, I've sort of kept more of an eye on than MasterCard. But do you see any obvious reason for that?
Yeah, so I think these are terrific companies. They're really the infrastructure of the payments. Almost all the new, everything new in payments has to go through Visa and MasterCard. So this year, there's been concern for Visa and MasterCard that stable coins and cryptocurrencies could displace their positioning among the payments ecosystem. And that's kind of the concern about Visa and MasterCard this year. We think that the chicken and the egg issue, that the ecosystem that Visa has built up with its merchants and the customers, will be very, very hard to displace. There will not be a lot of incentives for consumers to adopt stable coins, which is going to make it difficult for merchants to really drive stablecoin adoption. So we like the stock here, and we are going to continue buying it.
So you'd add in at this point?
Exactly.
Okay. Let's move on to another caller. Matt's in Saskatoon with a question. Hi, Matt.
Hi, Ernest, welcome. I think this is your first time on Market Call. I've been waiting for you, listening to your podcast. It's absolutely awesome for all those out there who haven't seen it or heard it yet. Please check it out.
Oh, you got your personal advertising there in from Matt. What's your question, Matt?
It's on Copart. I'm wondering if you could talk a bit about on its growth profile. It's really fallen back a bit here, and I'm kind of wondering, is the growth slowing down, or is there still opportunities for the company to expand revenues?
Okay, thanks for the question. So quite a sharp spike at the start of the year in the spring, and then I guess at the end of May is when it started really going in the opposite directions at 42.82 today. What are your thoughts on Copart?
So Copart is the largest provider of salvage auctions. So what that means is if you get into a car accident and the insurance company declares that as a total loss, it will most likely send the car to an auction run by Copart, which will where people in emerging markets and people who are scrappers will take it apart and sell the car. The issue for Copart this year has been, there's two issues. Number one is that because of the inflationary period from 2022 to 2023, more people are not getting car insurance. And so what's happening is that they're just driving around uninsured. And so this has led to a reduction in the volumes that Copart is seeing.
Okay.
The second thing that's happened to Copart is that there's been some concern that their primary competitor, IAA, has starting to compete more aggressively against them. We think that this is a very well-run company. They still benefit over the long term because cars are getting older and they're getting totaled more at higher rates. People are getting more distracted in their driving when they're driving with their cell phones.
And there's probably just more cars on the road as well. Right?
Exactly.
So the chances are higher.
And so it's a very well-run business, and we are still buying today.
Okay. Matt, I hope that helps you out. Let's go to Alfred. He's in Mountain View, California, with a question. Hi, Alfred.
Hi, Mirella. Thank you for taking my call. My question is regarding Berkshire Hathaway. The stock has outperformed in the second quarter and the third quarter, beating estimates. However, the stock doesn't seem to be performing that well. I'm a long-time investor, and I would like to hear your guest's opinion. Thanks.
Okay. Berkshire Hathaway, going sort of sideways and going a little bit down. It's at 4,483 at this point, up a bit on the day, 1.5%. Are people still concerned about Warren Buffett leaving the top job, do you think, or any other reason you see for this going sideways instead of sort of up?
Well, of course, he's the greatest investor of all time. I think that it is completely understandable that investors are worried about the ability of his successor, Greg Abel, to continue to compound capital at Berkshire Hathaway at the same rates that Buffett has done at the past. With that being said, we view Berkshire as a very defensive company in the portfolio. They have over $300 billion of cash today. They are reducing their equity exposure to wait for attractive investment opportunities. And a lot of their businesses within Berkshire, such as Geico, for instance, they've been improving the performance there as well. So we think that there's definitely a place for Berkshire in the portfolio, and we own it, and we continue to buy.
Okay. We are going to take a quick break. Ernest Wong is our guest today. He's with Baskin Wealth Management, taking your questions on North American large caps. Here again is how to reach us. We're back in a moment. Welcome back. Thanks for joining us. Let's go to the phone lines. Taraver's on the line in Sierra Vista, Arizona. What's your question today?
Thank you, and welcome, Mr. Wong. First of all, thanks to Market Call 3 years ago on a live programming with Barry Schwartz. I said, bring Ernest Wong on, and they did. So thanks.
You've got a lot of kudos going out there. Okay, what's your question?
My question is on TFI International. And can you explain, please, how do they're not asset light. How do they still make such good free cash flow? Thank you.
Okay, thank you for the question. This company has not recovered from the spring push down, and the whole space, I understand, this sector is one that remains depressed. But why hasn't there been recovery? And then if we can get to the cash flow after that.
Yep. So the issue for TFI and the entire trucking sector is that they're still facing a freight recession. Rates are falling. There were too many truckers added to the industry post 2022, and demand is weak today, especially as industrial activity and consumer spending is weak in the U.S. So that's kind of and then for TFI specifically, that is kind of the backdrop with which they acquired UPS Freight, which is their largest division today. And they're kind of struggling with improving the cost structure of this business today as well.
Okay.
What we like about the business is that the management has done a great job over time of making acquisitions, of integrating them into their network, of applying their culture and improving the cost and generating a lot of free cash flow, which is what the caller is asking about. And what happens for TFI is that they have the incentive programs are carefully designed in a way to maximize free cash flow. And especially so in weak times, where they will very carefully identify what capacity and what capital spending they need to spend. They'll increase reliance on third parties so that and contractors to reduce the capital burden on the business.
Themselves. Okay.
Yeah. And so what happens is that in bad times, free cash flow goes up. they're able to use that free cash flow to buy back stock at cheap prices, which they're doing, or make acquisitions of similarly distressed competition.
Okay, so there's the answer to that question. Thanks for calling in. Let's go to an email from Frank. Frank says, is Algonquin Power a good buy right now? Ernest, as you know, we've been talking a lot about different energy resources given the data center build out. What do you think of Algonquin?
So we don't own any utilities, but what we want to see in companies that are primarily, where the investors are primarily looking for dividends is predictability. And that's not what Algonquin Power has today. They've changed CEOs, I think, 3 times in the last 5 years. They issued a lot of debt to push into renewables. And then now there's an activist situation on the board and trying to unlock some of the value by maybe selling some of the pieces. So that is not what we want to see if we're looking for a dividend type stock. And while I think investors might make money if there's a sale or some kind of pop due to the activist situation, it's one where we would stay away from.
Okay. Frank, I hope that helps you out. Let's move on to Darcy in Stratford, PEI. Hi, Darcy.
Hi, folks. Thanks for taking my call, and I guess I'll second the endorsement of the podcast and David and Barry and Ernest's work that I've read over the years. I'm wondering about PayPal. They had earnings last week, if I'm not mistaken, and seemed like things were very positive. They were initiating a dividend. They had a deal with OpenAI. The stock went up $10, and now it's kind of back in the below $70. I'm just wondering what you think of this stock.
Okay, so PayPal in the same space that we're talking about with the payment systems. Any concerns?
Yeah, so the issue for PayPal has been that the competitive landscape for checking out online has just gotten that much more competitive over the years. They really benefited during COVID, again, as people were stuck at home and using PayPal to buy things online. But over time, we've seen competition from things like Apple Pay, things like Google Pay, and I think, and it's been difficult for PayPal to compete effectively, especially given the rate that they charge is very high relative to some of the competitors that exist. So very high motivation for merchants to find alternatives.
Sure.
And I think the valuation reflects that of PayPal. I think personally for us, rather than making individual bets on which button happens to outperform, we prefer to own the infrastructure such as Visa.
Okay. Darcy, I hope that helps you out. Let's go to Sean. Sean's in Markham, Ontario with the question today. Hi, Sean.
Hi there. Can I get your thoughts on Tourmaline and if you think this is a good hold for the next couple of years? Thanks.
Okay, thank you for the question. A lot of people are going into Tourmaline and ARC Resources on the natural gas play, hoping that that comes into the energy space for the build-out for AI. Is Tourmaline one you like?
Very much. I think the CEO, Mike Rose, has done a terrific job of building the company by acquiring low-cost sources of gas in the NEBC Montney, positioning the business to take advantage of higher gas prices as a result of LNG Canada. I think the stock has been weak over the last little while as gas prices have been weak, and also due to I think some commentary that they were going to focus on building out that infrastructure rather than increasing the special dividend. We think this is the right move for the long term, and think that the company will be rewarded for their investments.
Okay, we're going to take a quick break. We will be back with Ernest Wong of Baskin Wealth Management to take your questions. Stay tuned. Welcome back to Market Call. Let's go to an email right now from Janelle. Hi, says Janelle, what are your thoughts on Figma? The stock has fallen approximately 50% in the last 12 months of the last year. Is it a buy right now? Tell me about Figma.
So Figma is a design software that really makes it easy to collaborate on projects together. And they have done a terrific job of building the business over time. Adobe, which we own, has tried to buy Figma, but was fortunately blocked by regulators, and so they've now become a public company. We think that they are very well positioned in the AI space to take advantage by rolling out these AI features and making it easier for people to collaborate and work on projects together. We generally don't like to purchase names that are newer, that recently completed IPOs. We'd like to see companies have a bit of a longer track record of operations, but no doubt they've done a terrific job.
Okay, so would you buy in at this point, or you'd wait a little bit longer, essentially?
I think there's been a lot of concerns in the design space, especially with Adobe, about whether the number of whether people are just going to replace designers with AI overall. We think that it's more likely that AI is augmenting and making the designers more efficient rather than replacing them altogether. And so we like the space.
Okay. Let's go to the phone line. Jack's in the line. He's in Berry, Ontario, with a question. Hi, Jack.
Yes, hello, good afternoon to both of you. I would like to ask your guest, please, about Shopify, especially today that it's going down a lot and good earning. So I just want to know his advice, to buy it or to sell it. Thank you very much.
Thanks for the question. It's a pretty volatile stock, generally speaking. What are your thoughts on Shopify? Is it something you invest in?
So we don't have a position in Shopify. We think it's a very well-run company. They do a good job of providing kind of the back-end infrastructure for small businesses. So things like payments, the web hosting, the checkout flow. The real key for Shopify has been to really move from providing the back-end services to being able to drive customers for their small businesses. And because that is ultimately where, such as Google and Meta, that's where the money is going to be made. It's been a very difficult journey for Shopify to do this. They're recently trying again with AI. They launched something called Shopify Catalog, where you can browse across all their merchants. They're launching a new partnership with OpenAI, where you can buy things from Shopify merchants. But until they're able to solve this quote-unquote discovery problem, we think it's hard to be enthusiastic about the stock, especially at the valuation.
Okay, let's move to our next caller, Robert in Burlington, Ontario. Hi, Robert.
Good afternoon. Currently, I'm holding Suncor. I'm also holding Baytex Energy. And Baytex is still making money at these low oil prices, but because of the low oil prices, I think there's going to be a flurry of mergers and acquisitions. My two questions are, what do you think of Suncor on its own? And would Suncor be a company that would be interested in a company like Baytex? Thank you.
Okay, so very specific question. First of all, what do you think about Suncor?
Yeah, we like the oil sands overall. We think that over time, the big picture is that Canada has some of the largest oil reserves in the world, and they are largely untapped because of the lack of infrastructure. I think over the next 10, 20 years, as we start to build out this infrastructure, the value from these oil sands companies, such as Suncor and Canadian Natural, which we own, will start to be realized. And these are very long life reserves that are very well run with low cost operating bases. So they make a lot of money and they pay a lot of dividends. And we think Suncor is a great business as well.
Okay, any reason you would see that they'd be specifically interested in Baytex?
Yeah, I don't really have an opinion on that, but consolidation in the oil and gas sector in Canada has certainly been a theme, and one that we expect to pick up even more, especially as projects such as LNG Canada get online.
Okay, let's go to an email then. An email from Gurman, who says, can I please get the analyst's view on National Bank? Was the acquisition of Canadian Western Bank at a high price? So National Bank is what we will take a look at in just a moment. What did you think of the acquisition?
So we like the acquisition. We think that if you look through National's history, they have a really good track record of finding profitable niches that don't compete head-to-head against the other Canadian banks. So niches where they can earn excess returns without having to compete too aggressively. And that's what Canadian Western Bank does. National historically has largely been a bank focused in Quebec. Mm-hmm. They wanted to grow in Canada, and so they added Canadian Western Bank, which is largely a commercial footprint in Western Canada. And so we think that there's a lot of opportunities for them to be able to cross-sell things like wealth management to improve the capital efficiency of Canadian Western Bank, and we think it'll work out very well.
Okay. Another quick break for us. We're back with more Market Call in just a moment. Welcome back. Thanks for joining us on Market Call. Faisal is on the line. He's in Toronto with a question today for Ernest. Faisal, go ahead.
Hi, good afternoon, Mirella. Thank you for taking my call. Mirella, it's good to see new guests on the show. It's a positive thing. And for yourself, I'd like to thank you for probing the guests on these shows. You really get underneath and get to the issues. Ernest, welcome on your inaugural visit, my friend, and we hope to see you again more often going forward. My question is on RB Global Inc. It has sold off. It touched 160 and it's pulled back. The company has got a good business model. Can you let me know your thoughts on it and what is causing the pullback and what it would be like going forward? Thanks, Ernest. Bye-bye.
Okay. Thank you for the question, Faisal. RB.
Yeah, so RB has two businesses. The first one is an auction platform for heavy equipment, so things like Caterpillar, tractors, and those kinds of things. The other business is IAA, which is directly competitive with Copart, which we talked about a little bit earlier. So RB has done a good job over time of running IAA after they acquired it, of gaining market share in that business. But I think the reason the stock is down is due to similar issues as Copart, where people are getting uninsured and the volumes are not just as high as they were. So we prefer Copart personally. We think that they have a superior network of auctions, but we think that RB Global is a good business.
Are both of them North American?
Yes.
Okay, so when you say people aren't getting insured, that applies specifically, you think, to the North American market?
Yes, it's largely a North American phenomenon. The hope is that because car insurance rates and the car insurers today are so profitable, their margins are higher than they've been for a while. The hope is that as insurers start to compete again back for business, rates will come down and people will start to get insurance again.
Okay. Let's go to our next caller. Walter's on the line. He's in Kingston, Ontario. Hi, Walter.
Hi there. TD Bank. It's had a really good run. Would you buy at these levels? Thank you.
Okay, thank you for the question. TD Bank, of course, with a bit of a comeback after being pushed down in the U.S. and fined, and now capped as far as assets go in the U.S. So it's come back. It was under 100. It's come back. What are your thoughts on how much growth is left for this company?
Yeah, so I think for TD Bank and all the Canadian banks in general, the big story here is that a lot of the earnings growth over the last year has really come from their capital markets businesses and the wealth management businesses, because those are businesses that are benefiting from the strong markets overall and increased volatility.
Investors get also sort of putting in more money in and out all the time.
Exactly. Yes. If we look at the actual core retail businesses, not just for TD, but also the other Canadian banks, they're fairly sluggish. I think loan demand is still fairly weak, especially for mortgages. Delinquencies are still low but rising. And so we'll see if lower interest rates help with that. But that is, I think the other opportunity for TD Bank and the other banks is whether they can use things like AI to improve the cost structure of their business and really drive improvements in their cost structure going forward as well.
Do you feel that that is a significant goal for them? We're seeing Scotiabank already laying people off. And one of the things I did want to ask you about was, are we realizing some of that AI spend in the business models yet? Was Scotiabank layoffs related to AI and efficiency?
Well, I think TD Bank had an investor event just about a month ago, and they specifically said that they were looking to use AI to improve their efficiency ratio.
Which means reducing headcount.
Exactly.
Yeah.
Yeah. So I think that this flows to the theme about AI being a real phenomenon, and companies such as TD Bank and Scotiabank, not just the big techs, are really seeing benefits from using AI to save money.
And this early?
Yes.
Okay. Let's get back to the phone lines then. Lou's on the line in Markham, Ontario with a question. Hi, Lou.
Hi, how you doing today?
Good, thanks.
I'm curious about ATD, Alimentation Couche-Tard. Is now a good time to buy that, or would I be better looking at something like Dollarama?
Okay.
I appreciate your feedback.
Thank you for the question, Lou. So, company went after some 7-Elevens, was not successful doing that.
Yep.
If this is a company that grows by acquisition, what's left for them to acquire?
So the U.S. Convenience space and globally is still extremely fragmented, where companies such as Alimentation, Couche-Tard, and 7-Eleven only have like 5% market share in the U.S. So there's a lot of where most of the landscape, especially, is still independent, small chains. So there's a lot of runway for them to continue to make acquisitions, both in the U.S. and around the rest of the world. I think the not being able to buy 7-Eleven, from our perspective, was a disappointment. We thought that was a once-in-a-lifetime opportunity. But we think that the balance sheet is clean today. The CEO is still going out and looking for more acquisitions. They have a great track record of integrating deals, and we think that the stock is attractive here.
Okay, so you'd buy in at the level.
We own it, and we like it.
Got it. Okay. We're going to take a quick break. Get back with Ernest Wong of Baskin Wealth Management. Taking your questions today on North American large caps. Call us or email your questions in. Back in a moment. Welcome back. Let's go to Justin, who's on the line. He's in Cobourg, Ontario, with a question today. Hi, Justin.
Hi there. Hi, Marilla. Thanks for taking my call. Hi, Ernest. Great to see you on the show. Love the podcast and hope to see you on here more regularly. Just jumping to my question, I believe Baskin holds Stryker, and I was hoping you could give me your comments on that, your thoughts, and if you'd be adding to it at the current price.
I'm going to have to start a fan club. Ernest's fan club. Join us here. Okay, so Stryker. Tell me about Stryker.
Yeah, so Stryker is the leader in providing orthopedic artificial hips and joints.
Okay.
So if
big business right now.
It's a very big business. It's a very well-run company. And this is a business that's going to benefit over the next few decades as people are getting older. They want to get more active, and they're going to need hip and knee replacements. What particularly attracts us about Stryker is that they have a very good track record of making acquisitions, growing their portfolio of products that they can sell to hospitals, and really driving growth that way. So we like the business, and we continue to own it.
Is it a competitive space?
Yes and no. It's competitive in the sense that there are multiple companies that are providing these joints, but it's a very sticky business because the surgeon is often trained
in a certain product.
And they work very closely with the rep from Stryker, who's even in the operating room as they're operating on patients. So it's companies that do a good job of developing those sales channels are able to gain more market share, and Stryker has been the leader in that.
Okay. Let's go to an email then from JP. He says, my question for Mr. Wong is about RCL. I bought it during the pandemic at a ridiculously low price of $61. The stock went as high as $350. Now it's sitting around $265. Would you continue to hold, given that a frequent cruiser and benefits for onboard credits by being a shareholder? Thanks, JP. Okay, RCL.
Yep. So we don't own Royal Caribbean or other cruise lines, but I think the big picture for Royal Caribbean and the cruise space is that cruising continues to be a very attractive and affordable way for people to travel. And more importantly is that there's just no way to make enough ships today. I was looking at one of the cruise manufacturers, the ship docks. They're sold out through 2035. So there is just no capacity in the industry to be able to add new ships. And so what you're seeing is that all the rooms are sold out in advance. Pricing is going up, and people are booking their vacations over a year in advance.
Wow. Okay.
And so that's kind of what is happening with Royal Caribbean. I think the challenge for them will be at some point the backlog is going to clear up. Because there's such a long backlog, they've committed orders years in advance. And so if there is a pullback in consumer spending due to travel, recession or whatever, will they be able to fill the new boats that come online? And so that's kind of the question that we have, and something to keep watch for.
Demographics, because we are an aging population.
Yes.
I would imagine they're also going to benefit from that.
Oh, yeah, yes, for sure. And what we're seeing is an increased trend towards these luxury cruising experiences that are more focused towards catering to the older population. I think Royal Caribbean has built a business that is more focused on these types of travelers rather than,
celebrity cruises, which is geared for younger people. Okay. All right, let's go to another caller. We have Robert on the line in Scarborough, Ontario, with a question today. Hi, Robert.
Hello. Thanks for taking my call. My question is on Thomson Reuters, TRI. I know that it reported its third quarter results this morning, and it missed on revenues, but it beat on earnings. And it's had some solid returns in the last 5 years. So my question is, do you own the company? And if you don't, would you buy it here at this during this downturn?
Okay, good question. Do you own anything in this space?
So we don't own Thomson Reuters, but we have followed the business. They've done a remarkable journey in kind of streamlining the business and focusing on the parts of the portfolio that they really want to focus on. So they exited the financial data business, and so now today is essentially just providing information to lawyers, providing software to accountants, and these are good businesses where Reuters is the market leader. The question for Reuters is about whether AI is going to benefit their business or is going to hurt their business. We think that it is going to benefit their business because as they make it more efficient for lawyers to be able to do things like searching through old court cases and those kinds of things, it will make them more efficient. We're already seeing legal firms hire less juniors because their seniors are more productive. And most of this is going to benefit Reuters in the form of price increases. Okay. So I think we never bought the stock because of valuation, but certainly one that is intriguing.
All right. Let's get to another email. This is from Bruce. Bruce says, could Ernest comment on an outlook for P&G at this time? P&G.
Yeah, so for consumer staples overall, it's been a difficult few years because what happened is that in 2022, because there was a lot of inflation, all these companies took the opportunity to raise prices. And so as a result, today what you have is prices are high, the low-end consumer is weak, and demand and market growth for things like detergent and shampoo were just not that high to begin with. And so they're more cyclical than they have been in past cycles compared, because especially since consumer staples are supposed to be defensive.
Sure.
I think that long-term, P&G is a very well-run company. They do a very good job of redesigning and repackaging their products in a way to drive price increases. But we prefer to own names that are growing a little bit quicker.
Do you feel like the staples are still defensive? Because as you mentioned, it definitely hasn't acted that way for a while.
No, and I think that's really the key, which is because of the price increases and because of the focus of these companies to premiumize their products, they have become more cyclical as a result. And so what happens is that if there's a recessionary period, consumers, especially lower-end consumers, they're more likely to trade down to private label, or they're more likely to shop at places like Costco, which make less money for the consumer staples companies.
Okay. That is all the time we have for phone calls and emails, but Ernest will share his top picks when we come back. Join us tomorrow for Market Call. Kim Bolton will be on the show. President and Portfolio Manager Black Swan Dexteritas. He'll be taking your questions on technology stocks. That's tomorrow. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, let's get some top picks from Ernest Wong, who joins us today. We start with restaurant brands. QSR on the TSX. This is the company that owns Tim Hortons and Burger King and Popeyes.
Yes.
We talked about the consumer spending situation right now being a little bit weaker and maybe not going out to eat as much. It is at 92.72. This is a company you would put some money in today?
Yeah, so Restaurant Brands is currently 3 years into a turnaround where the executive chairman, Patrick Doyle, he came from Domino's Pizza. He saw that there was a business that had a lot of potential. And so he embarked Burger King, especially, onto a long turnaround where the franchisees would upgrade their stores, they would invest in technology, they would improve the menu, improve the advertising. And we're starting to see fruits of that 3 years in, where in a very difficult consumer environment, both Burger King and Tim Hortons grew same-store sales this quarter.
Okay.
So the things are definitely on the right track. And the reason that we like the stock now is that it still trades at a fairly large discount to other fast food companies, despite outperforming on a relative basis. And so we think that especially as they start to refranchise some of the stores that they acquired for Burger King, free cash flow is going to go up and the multiple will converge with the other stocks.
So is some of this where I would walk into a Burger King and notice that it is a revamp?
Oh, for sure. I think a lot of the Burger Kings before were quite frankly old and tired and had old paper-based menu boards. Mm-hmm. Now they're all digital. It's very clean, very modern, and more importantly, is they're using a lot of technology to drive sales through the app and those kinds of things.
Okay, let's get to your next pick then, which is CCL Industries, CCL.B on the TSX. This is a company that makes labels, which I'm trying to figure out how much money there is in label making.
I think you'd be surprised. CCL Industries was one of the first companies that I ever studied. And my reaction was exactly that. How exciting can labels be? Mm-hmm. But they really focus more on higher value labels. So things like they participate in the GLP-1 space. Okay. They make labels for those types of drugs. They make a lot of labels for electronics. So when you buy an iPhone or when you buy a Mac, a lot of the labels are made by CCL Industries. Okay. And what particularly attracts us about this name is that they have a really, really good track record over time of making acquisitions to enter into these new markets. And I think the stock has underperformed over the last little while because they've slowed down this pace of acquisitions. But the balance sheet is clean today. They're buying back stock with excess cash. And we think that as M&A picks up, the stock will continue to perform.
So when you say they acquire other label makers?
Yes.
Or really interesting.
Yeah.
Okay.
So they'll acquire label makers in adjacent categories. So, for example, they recently made a label acquisition in healthcare in Germany. They recently made an acquisition in the plant space. So when you're buying flowers at stores, you know those labels that
Home
identify
Depot,
them.
Sure.
Yes, those are CCL labels.
Interesting.
And they also, because they're a trusted operator, often acquire or build label factories in emerging markets on behalf of their customers. So that's been something that has driven their growth as well.
Okay. Let's get to your third pick then, Constellation Software. A lot of questions about this company right now. As you know, the share price has dropped off between the head of the company having to step aside and then the business model being questioned. You like this stock. Tell me why.
Yeah, so Constellation has performed so well for so long that I think any time that something comes in and the stock takes a dip, people get concerned about what's happening. We're not concerned. We think that the two concerns about the stock right now are that with CEO Mark Leonard having to step down for health reasons, that they won't be able to make acquisitions at the same pace that they used to do. We don't think this is an issue because Constellation is a very decentralized business where most of the acquisitions take place are not driven by the CEO. They're taking place at the business units themselves. And I think this has been demonstrated by the spin-offs that they've done, where Topicus.com and Lumen are independent public companies, and they continue to go out and make acquisitions. So we think that as they continue to deploy capital, they continue to demonstrate that they're able to do M&A without Mark Leonard. The stock is very attractively priced.
Okay, and in 30 seconds or less, what about the software business being at risk because of AI?
So I think that's less of a concern, because you have to keep in mind that most of their customers are very reliant on Constellation solutions. So it will be very difficult for them to switch out of their solutions and replace it with an AI solution.
It's embedded, essentially.
Exactly.
Got it. Okay, Ernest Wong, thank you for joining us today. Appreciate your time.
Thank you.
And that does it for Market Call today. Thank you for joining us as well. We'll see you back here again tomorrow.